What is happening with the yield curve this week, Martin?
Casper, what we have seen this week is something really interesting. It doesn't happen very often, but it is a signal of a recession. So what is happening? It's an inverted yield curve, which basically means, of course, what is a yield curve? First of all, I think you know what it is, no?
I know.
A yield curve basically is that you know that the U.S. Treasury, the central banks, they give out new loans on a constant basis. Now, they all have different maturity times. So a loan of 3 months, a loan of 1 year, 2 year, 10 year, 15 years, 20 years, etc., etc., etc. So if you plot those, plot means that you put dots in a chart and you then pull a line, you get the yield curve. So you see the 30 years Treasury now has a yield of 5% and the 2 years has a yield of 3%, etc. So you will see automatically what the different percentages are that the US Treasury is giving. Now, what is happening this week, and actually yesterday on Thursday, is that normally a yield curve goes up. That's the normal scenario. Why? Because if you take a long-term loan, the risk that something happens in the period that you have to pay it back, just thinking from an investor perspective, is that you can't pay it back, that something occurs which brings you into difficulties, is higher, so you need to pay a higher interest percentage. Now this week, yesterday, we saw that the 10-year Treasury and the 2-year Treasury were actually at exactly the same percentage, or even slightly below. So we saw that the 10-year Treasury was at 2.39 and the 2-year Treasury was at 2.41. So that's what they call an inverted yield curve. And why is that so important? Is that normally we see that, what I said before, the yield curve goes up, and if we look at the history, and I'm talking about not just a couple of weeks, a couple of years, we look back at 1955, since that moment it has 99% of the times been the case that when you have an inverted yield curve, a recession happens 6 to 24 months.
99%?
Yeah. There's only one time that it didn't happen, so I say 99.9%, but it happened almost all the time.
To get a feel, how many of those yield curves did occur in that period of 70 years? Was it like 4 times, 30 times?
No, I think it was
50?
about, if we have to quantify it, I think 25 times or something like that.
Something like that, yeah?
I don't have the exact number, but it can sometimes happen just really quickly. So that's why it's really important, the moment that we have started now, to see if it will prolong during a longer period of time. Because if that is the case, then...
Yeah, that was my next question. For how long does this need to occur?
Yeah, well, of course we know already the definition of a recession is that you during a longer period will have economic slow.
No, but I mean this yield curve. Does it need to occur for at least, for say, a week or a month?
Yeah,
so
there's no rule for that.
Okay.
It
can also be one day.
Yeah, that's why I said it's really important to see how long it will prolong now, to see whether indeed we will get into a recession. We do know that from the past, for instance, I have a couple of data here. In 1998, we had an interest rate of 5% in the market, and we saw an inverted yield curve for a couple of months. What the Fed did, they cut the rates, and they managed to solve that issue. So they managed to avoid the recession. In 2006, 2 years before the big recession, we could say that was the big recession, we saw also inverted yield curves for almost the whole year. The Fed at that moment didn't do anything because we still had quite some growth in the US because of the property prices, etc. But we had an interest rate at that moment of almost 4.5%. And then in December 2007, we entered into a recession and the interest rates were lowered down to 3%. So the Fed now at the moment is just doing the opposite. And that's why it's also an interesting time, because we have really high inflation. We saw today in Europe, inflation over, was it
7.5%?
7.5%.
In Spain it was 10, and in the Netherlands it was almost 13%.
Yeah, and in the United States,
year-to-year basis,
it's also something like that.
Yeah.
So that's why you asked me last week, Martin, what do you think if it's a good thing what Powell is doing to raise these interest rates to fight inflation? That's the only thing it can do. So if we are now having this high inflation, and the tool to bring that down is increasing interest rates, but also the tool to fight an inverted yield curve is lowering interest rates. I think what they call it in a spagat, no? There's really difficult moment now to decide for central bankers what to do. And
is that, you think, the reason why the ECB didn't increase the interest rates a lot yet?
Yeah, might well be. Yes, it might well be. I have no answer to that. It's because it's guessing, no? If they
but already you said it just occurred. So
it just now occurred,
yeah,
of
so
course,
it may be not it's not a maybe reason from the ECB to do it, not because it didn't occur before only in 2019.
Exactly. I think the most important thing is what you can read from this is that the investor sentiment on the longer basis is becoming negative. Because that's why people are pulling out money out of
it's in general the problem is still the inflation is whatever it is, 8% on a yearly basis maybe. On an interest account you don't get anything.
No.
So there is already the problem, and then then a lot of people are investing because they want to fight inflation.
Correct. So that is the biggest worry, the biggest thing what you can read from these, what I read also in different news in Reuters, for instance, or in Bloomberg, is that the market on itself thinks they're worrying whether the Fed is capable of doing what we just mentioned. No, if they're capable of, first of all, raise the interest rates to fight the inflation, other sides, what they're going to do with this.
And you said there is a delay. So normally when this curve occurs, then within a certain time frame, normally what you saw in the past in 70 years, you see that the recession starts. What is that time frame?
Between 6 and 24 months.
Yeah.
You saw in 2006 we had the whole year, and the recession came end of 2007. It's also very important here that the fact that we have an inverted yield curve, that does not cause the recession. It's just a signal. And there's also academic studies. They say that you need to look at the 10 years and the 2 years. And you asked me before also, but if what Powell is saying in the last FOMC meeting, he said, no, we need to look at the 18-month and the 3-month bill. And that is maybe because the economy is so quick and things are changing so quickly that it doesn't make sense to look at those longer term yields. I think it's not very clear to me whether he says that for...
but he will probably have said it in his advantage.
So
to support his
vision, of course. So I think it's something that we definitely need to look out for, because we know if we get into a recession, and many times we saw stock markets in also 1980, for instance, we had a big crash of the stock market. Also, I wouldn't say the trigger, but a signal came with the inverted yield curve. We saw 2006, what happened afterwards in 2007 and 8. So 2019, we saw what happened in March 2020. So it's, like I said, guys, it's really important to keep an eye on this. I think.
And from an investment point of view, normally the stock market reacts earlier than an economic situation. Yeah. So if there will be a recession in a year, for example, normally the stock market is already going down before that year. It's always faster than the rest. So keep that in mind.
And one of the things that you then get asked is, what should you invest in? Well, without going into the direction of saying that you have to, but there are investment ETFs. It's called TIPS, Treasury Inflation Protected Securities, and they follow they benefit from these sorts of situations when you have like high inflation environments and interest rates markets that are moving a lot. So that is something that you could investigate for the moment. Anything else that you want to add, Casper?
I think from an economic point of view, it's also with this inflation rates, the market is looking at salary increases. And if you do that, of course, then you see that always is a negative for the margins of the companies.
That's another thing.
I think you're now living in a time where margins are smaller than 20 years ago because of the internet. Margins. Revenues are higher, but margins are smaller. So that's also the spagat where you were mentioning. So there is not a lot of room for increasing the salary.
No.
But if you don't increase the salaries, then people the spending power is
getting reduced.
Is decreasing very fast. So. I think it's a really difficult situation, and it also the problem is that it went up so fast. We're talking about inflation for now how long? A year?
Over a year.
Before that, it was not the case. It was the normal 2-3%, and suddenly it went up.
It went up pretty quickly. Same thing for banks, because if you have the normal, if you go back to the yield curve, with a steep, banks can borrow cheap and lend long term for a higher rate, so they make money. But now in this situation, banks also will get into trouble again. So
And that's an important group of the economy.
Very important, yeah.
Other things that you saw this week?
Biden yesterday, the release of I think the biggest oil reserve release in history that he presented. So they are really taking advantage of.
It's always good that they have some stock, eh?
Yeah,
in those products.
Think ahead, yeah.
If you don't have any stock, you can't release it.
No. So that I think is good. We saw again. It's coming back to the same topic again. But yesterday, Taco also mentioned.
What did the oil price after he released? He announced.
Oh my God! You asked me things I didn't check that.
Okay.
Did you check it? You asked me to see if I checked it?
No, because I'm only asking you something if I don't know the answer.
I don't know it. I don't know.
I think it went down.
It could
Look at the cameraman. Did the oil price go down today?
Cameraman doesn't know.
Yeah. Cameraman doesn't know either. Okay, well, that's well prepared.
Okay,
no, but
please put it in the comments.
Yeah, we put it in.
Well, if we are behind our screens, we will find out.
Exactly. Now and then, Taco also mentioned yesterday that Baidu, which is sort of like the Chinese Google, is really struggling with what we mentioned a couple of times with the listings on U.S. markets for Chinese stocks. That happened again.
The diamond.
The diamonds, very important. Yeah, we were again a little bit ahead of the news, I think. No, Zelensky yesterday spoke with all the different European governments, with the Netherlands and with Belgium, and in Belgium, and in Belgium specifically, he made a mention about the diamond industry and the.
We talked about it last week in our last vlog. If you want to look it back, you go to the previous
vlog. Yeah. So, all in all, I think exciting markets. We went down slightly again the last couple of days after the recovery. Also important, if I checked that with some people this week as well. You see that the drop in the market. If you look at the Amsterdam market or so, like or any market, you saw that it was with very high volumes. However, the recovery, the last 2 or 3 weeks, was with very low volumes.
And that's an important one.
Yeah, because that means that there was not a strong recovery. So
be aware.
Thank you for watching.
Thank you, Martin.
Thank you
for the explanation. Really interesting. Thank you. Give a comment, give your thumb up, and hope to see you next time. Thank you.